Hello viewers, we'll be going over gold futures. In this video, we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, comparing the current trend with the trend in the past, and we'll go over the day-by-day forecast for gold futures. So back to the technical analysis, gold is around 6%, or I should say 6 basis points on the 1 hour chart. We are still in positive MACD. We have now seen a converge, and we may see a struggle to the upside. If we zoom out to the 4 hour chart, we saw a convergence after approaching to negative MACD, and at the moment we also see a convergence, the 9 moving average converge onto the 18 moving average, the blue and purple line respectively. As for the daily chart, what we have here is we see a slight divergence in play at the moment, and for the moment for gold futures, we are still remaining and averaging higher lows, so the momentum is still to the upside. If we do continue to the upside, the next possible resistance will be where we left off back in July 8th at around a price of $1,830. And to the downside, if gold were to reverse and head down lower, the next possible support will be the 18-day moving average, this purple line. And that coincides with previous resistance, and since we're above resistance, that now acts as our support. Again, that price is around $1,791. If we were to hit that price support, that price movement is roughly around 1.4% to the upside, and to the upside, that price movement is roughly around, say, 1.3%. And now let's head to the day-by-day probability model. These models are available in the link below, so do check it out. As we progress to the 50, about a week of trading, we have a 27% chance for gold futures to climb between 0 to 1.6%. And to the downside, we have a 27% chance for gold futures to fall between 0 to negative 1.6. And on the extreme case, to the downside, we have a 45% chance for it to fall between negative 1.6 to negative 3%. So now let's examine the day-by-day forecast for gold futures. So we have 1 day out, that will be a Thursday, and 2 days out will be a Friday, and so on. So we have 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend. The blue lines are current trend, and overlapping it happens to be the best match. Right here we have our current trend, and below is the trend that we found on the line graph above. This trend dates back to January 29th to April 25th, 2007. So let's begin comparing both of the trends. On the current trend, we start off at the upper Bollinger Band, and then we proceed to dip lower and average above the middle Bollinger Band towards the end. So we see that pattern here as well. Start at the upper Bollinger Band, proceed to touch the bottom band, and then average above the middle Bollinger Band. What we have here is 1, 2, 3 points, and we also have 1, 2, 3 points on the current trend. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was back in January 29th to April 25th, 2007. Back then, gold futures was down roughly around 1.8%. So if we head back to the day-by-day probability model, that coincides with this standard deviation of 45% chance for gold futures to fall between negative 1.6 to negative 3%. Let's examine closer on the technical performance of each model. On the current trend, we're 0% away from monthly high, up 7% from monthly low, up 91 basis points from 10 simple moving average, up 2% from 20-day simple moving average, and up 4% from 50-day simple moving average. Compare that to the trend that we just found. Back then it was down 1% from monthly high, up 7% from monthly low, down 12 basis points from 10 simple moving average, up 1% from 20-day simple moving average, and up 2.7% from 50-day simple moving average. So there is a slight technical difference among the two trends. One is the 10 simple moving average, down 12 basis points in the past. Compare that to the current trend, which is up 91 basis points. So do keep that in mind. Again, these models are available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.